Hello and welcome to John Author's Note. One of the most remarkable market phenomenons of last year was a sight of bond yields grinding lower and lower in large swaths of Europe. The UK and Germany, the traditional safe havens, were not the only countries to see their benchmark borrowing costs dip to multi-century lows. Even France and Belgium, fairly indebted, weaker economies, were embraced by investors. Paris's bond yields are now almost as low as the UK's. However, there are many who fear that Europe's so-called core is almost as rotten as its periphery. Could this be the year when problems start to crop up in the stronger European bond markets as well? Or will yields stay this subdued? With me to discuss this is Justin Knight, Head of European Interest Rate Strategy at UBS. Justin, thank you so much for being here today.
Thank you.
Well, if we bring up our first chart here, we can see the 10-year bond yields for a few core European countries. They just dropped and dropped and dropped and dropped throughout 2012, almost without interruption. But we see a little bit of a bounce here towards the end in early January. I mean, is this showing that maybe we've seen the end, we've seen the bottom?
Well, of course, this bounce has been driven by the aversion of the fiscal cliff over the last few days by US politicians, and of course it remains to be seen whether that situation is going to maintain. And we do think that curves in the US will steepen over the coming weeks, which will mean that core government bond yields in Europe will probably follow suit. But beyond that, in the US, we think that the Fed is going to be buying around 80% of the net issuance this year, and indeed that there is a reach for yield both with US investors and with core government bond investors in Europe. And what you have to remember is that there is a lot of money just going into core government bond markets now that used to go into core plus periphery in the past. As investors have abandoned the peripheral markets, some of them, and are not going back, then they're going into core anyway. So that means that even if we get a significant rise in core government bond yields in Europe, we suspect that it's going to be limited to the upside. So if we're looking at Germany at around 144 in the 10-year today, then we're looking at about 165 over the near term. And if we get to levels of around 180 to 190, perhaps because of a very extended risk on move, then I think that will be very, very attractive to global investors kind of everywhere that have any part of their portfolio in Europe.
So it's a slight rise, but nothing dramatic is expected.
No, exactly. And I think then later on, we're expecting yields to fall once more, particularly as we see problems resurfacing in the periphery. Spain has a lot of government bonds to issue this year, and we don't think there are enough buyers for that.
We're not going to get into the position where that actually things are so difficult in Europe that the core gets infected as well, as either we move towards resolution of the European crisis where the stronger members backstop the weaker ones, or frankly some sort of Armageddon-like scenario where the euro dissolves, that in fact everybody gets dragged into the maelstrom.
Correct. I mean, I think what we're really looking at is of course a solution to the European crisis, but it's not anything that's going to happen very suddenly. If we do get a much stronger worsening of the crisis, like we had in sort of June and July, and we think that may well happen in the second half of this year, then Germany still remains a safe haven. And certainly up until that point, so does France.
So next week, the Netherlands is selling some new bonds with collective action clauses in them for the first time. And these have been mandated by the European governments for all European government bonds. I mean, is this going to have an effect?
Well, I mean, as you say, this is mandated for all new government bonds. So the issuance that we've seen so far this year have been taps of existing bonds. Some in the market do believe that these bonds, because they contain collective action clauses, should be cheaper than similar bonds, i.e. theoretical identical bonds without collective action clauses. We don't agree. All of the bonds pretty much in Europe have been issued under domestic law, and were a country to restructure its debt, it could simply do what Greece did in February of last year, and that is to pass a law domestically to retrospectively introduce collective action clauses into the pre-existing debt, and then restructure all of the debt. So we would expect actually these bonds to trade at almost identical yields.
Well, Justin, thank you so much for being here today.
Thank you.
The European bond markets might not be hitting a CAC hurdle in 2013, but I doubt that anybody will be betting on the end of the European debt crisis anytime soon.